Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man, America's annuity agent, licensed in all 50 states, clients in all 50 states, and hopefully you're either one of them listening out there in the hinterlands or you're thinking about being a client of the Annuity Man. We would certainly love to speak with you and see if an annuity strategy is appropriate. It might not be, but we certainly would like to run the quotes and have the conversation and at least dig in to see if that makes sense for you and your specific situation. So today's topic is, what do annuities contractually solve for? How about that? I mean, everybody's got selling it out there has their favorite annuity, right? Not me. I don't. I'm trying to figure out, A, if you need one, and B, if you need one, then what type, and then C, let's go contractually solve for that, looking for the highest contractual guarantees. It's pretty basic. I've kind of stripped this whole thing down into the simplistic view of annuities, and I think it's the right way to do it. I think eventually you're going to be able to shop and buy them yourselves without an agent. Right now, at the time of this podcast, you've got to use the agent sometime in the process, just by law. Now, what I've done on my site, theannuityman.com, is I give you two choices on how to shop. You can choose to shop with the Annuity Man and my annuity experts, and there's not a ton of them. There's a handful, because they have to go through some rigorous filters by me, because everything that I do, my hand's all over it. There's nothing I'm farming out. I'm looking at every single case, every single thing, and making sure that we're doing it the right way. So with theannuityman.com, you can have in essence, an annuity advisor, personal, one-on-one. You can talk to, we can put together customized plans. And even if you're not speaking with me, most of you will, but even if you don't, I'm looking at what you're doing. Believe me, I'm signing off on it, because I'm going to have to sign the paper at the end of the day. I'm signing the application with you. Or you can go to Annuities.direct, which I also own. And that's for the people that want to do it yourself and get their own quotes on their own terms and run the quotes and shop around and not talk to anybody, which is fine. And then at the end of the day, they don't want to engage unless they're at the finish line, and they need to engage and make sure that they're doing the right thing and make the right decision. So theannuityman.com, and then within theannuityman.com, annuities.direct. Either way, you can shop on your terms and your time frame, and that's the way that I think it should be done. And because of that, that's the way I designed it. So, the question, what do annuities contractually solve for? The first thing you need to understand is annuities are contracts. They're not investments. And I know I get a lot of pushback from the industry about that, and from people that sell variable annuities, etc. And they have their case. But if you don't believe annuities are contracts, buy one. And they call it a policy. You can call it a policy. I'll call it a contract. You're going to get a contract. An annuity is a contract between you and the issuing life insurance company. Period. It doesn't matter what type you get. Fixed index annuity, multi-year guarantee annuity, single premium immediate annuity, deferred income annuity, qualified longevity annuity contract, variable annuity. Doesn't matter. You're going to get a policy in the mail. It's a contract. So, in my opinion, if you're buying a contract, you should be owning the contractual guarantees. You should be making the decision to buy solely on the contractual guarantees. And I will cover how that applies to indexed and variable annuities in just a second, by the way. And just for the record, I don't sell variable annuities. I'm not giving advice on variable annuities. I don't give that type of market advice. I sell contractual guarantees. I sell fixed products that, for what they will do, not what they might do. I'm not down on variables. They were put on the planet in 1955 for tax-deferred growth. And in some cases, that does work. I do like some of the no-loads out there. But still, even the no-loads have limited choices. And I think if you want market growth, You don't need limited choices. So let's go through kind of what do they contractually solve for. I use two questions I asked everybody. What do you want the money to contractually do, and when do you want those contractual guarantees to start? From those two answers, I can then point to what annuity type works. And then I use an acronym called P.I.L.L. P stands for principal protection, I stands for income for life, L stands for legacy, the other L stands for long-term care. So I'll do it again. P is principal protection, I income for life, L legacy, leaving money to heirs, and the other L long-term care. Notice there's no G. There's no growth in there. It's not P.I.L.L. G. It's not G P.I.L.L. And the reason is, like I just previously said, market growth should have no limitations. And any type of annuity that's promising market growth has limitations, especially the indexed annuity side. That is a product that was developed in 1995 to compete with CD returns. It's in essence an enhanced CD product, and there's nothing wrong with it. I like that product if people understand that it's not too good to be true. So the question is, Stan, the Annuity Man, is if I buy an indexed and variable annuity, how do I buy it under the guise of contractual guarantees? Well, you buy it for the contractual guarantee. What's the contractual guarantee of those policies? In other words, what's the worst case scenario of those policies? Whether they're standalone policies with no riders attached, or if you attach riders, which are riders in the annuity industry, English please, Stan. Riders means attached benefits at the time of application. Most riders to policies like indexed and variable annuities are what's called income riders, which are lifetime income guarantees that you can start at a future date. In essence, that's what they are. So, in my opinion, that's what you should base your decision on. So, for the indexed annuities that I sell and recommend, I'm recommending them solely on the contractual guarantees of that income rider, period. We're not looking at the accumulation value at all. In fact, you want a visual? Here's the visual. Draw a line down the blank sheet of paper visually, or do it, just grab a piece of paper. Left-hand side is the accumulation value side. That's the walkaway amount. That's the investment side. And then right-hand side is the income rider side, which is the guaranteed income at a future date. To the penny at a future date what your guaranteed income will be. Here's what I do with people. All right, you have the two columns. Draw a huge X on the left-hand side, which is the accumulation value. Just draw an X through it. What that means is we're not going to talk about that. It doesn't matter what happens over there. Could care less. We'll throw a dart at it. What I care about are the contractual guarantees of the policy, and that's the right-hand side of that ledger. And by the way, when annuity companies design these products and you attach an income rider to them, or a death benefit rider, which could be a combination income rider, death benefit rider, that rider side, when you draw that line down the middle of a page, that right-hand side of the ledger not typically, but pretty much always is higher than the accumulation value side. I know there's somebody going to hit me with some exception, but I'm saying most of the time. And annuity companies design it that way, so that right-hand side of the ledger is higher than the left-hand side, meaning that if you wanted to cash in that annuity, the income rider is not fungible. It's not cash. You can't cash it in. You're going to get the accumulation side, the side that you just X'd out, the side that I don't care about, the side that I'm not making my decision on. So annuity companies do that for a reason. The right-hand side of the ledger is going to be higher. Why? Because if you want to access that benefit, you have to stay in the policy. It's smart. It's good business. There's nothing to blame the annuity industry on. If I was a carrier, I'd do the same thing. I'd make sure that right-hand side of the ledger, that monopoly money, phantom account, income rider side, is higher than the accumulation walkaway amount. It just makes sense. So that's the way that I'd go about it. In my opinion, in a perfect world, qualified longevity annuity contracts should be the number one selling product on the planet. What do they solve for? They solve for future income using traditional IRA assets or 401ks if your 401k or 403b or whatever is participating in offering those. There's so much money in traditional IRAs that everybody that has one should at least quote a QLAC. Now, great story. I had a gentleman call the other day and say, hey, I don't want a QLAC. I could care less about future income. And I said, you're right, but how about setting it up so that you can add your spouse with the QLAC, even though it's your personal IRA, you can add a spouse for joint lifetime income, why wouldn't you just add your spouse and that be somewhat of a legacy for you? Even though you don't need income, but when you die, when your Learjet hits the mountain, then your spouse gets that lifetime income stream, and they did that. And a lot of time, I'm seeing a lot of QLAC sales based on that type of emotion, which is taking care of your spouse or partner. So what I would warn you out there in the annuity bad chicken dinner seminar hinterlands is to be careful when people start throwing phrases around like hybrid. I have a hybrid annuity. I have an annuity that does it all. I have an annuity that gives a bonus, and it has market participation, and it has confinement care, it has long-term care, and it has everything. It's got every little whistle and bell on it. In my opinion, when you solve for a specific goal, whether it's income or legacy or long-term, remember the P.I.L.L, principal protection, income, legacy, and long-term care. Remember? When you solve for that, you solve for one at a time. There's not one product that does it all, even though everyone's trying to either design it or sell it. You're better off, and you're going to get a higher contractual guarantee by going at each part of that P.I.L.L individually. So if you said, okay, I want the best legacy income rider, death benefit rider, then let's go shop for that. Or I want the best confinement care rider attached to an index. Okay, great, let's go shop for that. Or, hey, I want the best income rider for future income. Okay, great, let's go shop for that individually. Now, that's not some ploy for you to buy 4 different annuities. The point I'm trying to drive home is if you're going to buy an annuity for a specific solution, principal protection, income for life, legacy, or long-term care, confinement care, then go shop for that specific goal and go find the highest contractual guarantee for that specific goal. Now, at the Bad Chicken Dinner seminar, they're going to say, well, this one does it all. It's a hybrid. Listen, hybrid's a car, hybrid's a plant, and I even saw the other day on an ad, hybrid can be a mattress of all things. Hybrid's not an annuity. People call me all the day, what's the best hybrid you have? And I say, currently, I think it's Toyota, but I think Honda's real close. Joke. But I'm serious. When people throw the word hybrid around, they're trying to play word games and semantics. I really think the industry should shut that down. And they have a lot. There's recently a TV ad I saw, and some agent threw the word hybrid out. It was a national ad. And the next time I saw it, he wasn't using it. I'm assuming somebody at the carrier smacked him down and said, would you please stop? Or the person that runs the ad that never mentions the word annuity and just mentions all the benefits, it'll do this, it'll do this, and do this, and never mentions the word annuity. I mean, one of the reasons I call myself Stan the Annuity Man, and the site is theannuityman.com, is we're not hiding from this. Annuities have benefit propositions that no other products have. The one monopoly that annuities have that no other product has is it guarantees a lifetime income stream for as long as you live, period. There's no ROI until you die. It's the only one that does that. The other thing that annuities have that no other product has is you can test drive it and get your money back after the policy's been issued within a free look time period. That's phenomenal. Come on now. So, when you're looking at annuities are contracts. So you have to say, okay, what do they solve for primarily? And if you don't need to contractually solve for principal protection, income for life, legacy, and long-term care, then guess what? You do not need an annuity of any type, period. End of story, end of sentence. Which is what drives me crazy about the Bad Chicken Dinner seminar circuit. If you're a living, breathing human being that has a bank account, you're getting these things in the mail that come to this steakhouse or whatever, restaurant and hear the presentation of how markets are going to crash and how we can protect you from it, etc. And 100 people show up and they're talking about one product. That's like a doctor holding a seminar and talking about one medicine. It doesn't work like that. From a fiduciary standpoint, which I think all people that in the financial business just by reflex should be fiduciaries, meaning you're putting the client's needs ahead of yours. There's no way if you're presenting, I don't care if it's an immediate annuity. You can't present an immediate annuity to 100 people and all of them need an immediate annuity. You can't present an indexed annuity to 100 people and all of them need an indexed annuity. But for some reason, that's how it goes. And so your question is, well, Stan the Annuity Man, then why don't you do a Bad Chicken Dinner or preferably a expensive steak dinner seminar and talk about all types of annuities. Number one, I get paid to speak. I don't buy people dinner to speak. But if I did bad chicken dinner seminars or steak dinner seminars, the title of the presentation would be Annuities: The Brutal Truth, the Good and the Bad and the Ugly. I mean, I would tell everything about it and then leave it to you to make the decision. So, in conclusion, what do annuities contractually solve for? Remember, ask the two questions: what do you want the money to contractually do? And when do you want those contractual guarantees to happen? Never make a decision on hypothetical, theoretical, back-tested, projected, hopeful agent return scenarios or some stacked, just all the nonsense that's out there. Do not buy an annuity with the planets hoping to align or the unicorns chasing the butterflies. Buy it for the worst-case scenario, the contractual guarantees, and you will be a happy camper. You will like the annuity transfer of risk solution that you get. But if you buy it for the back-tested number, the hopeful agent return scenarios, if you'd have owned it this time, you'd have made this, you will not be happy. I will guarantee that, because hypotheticals never come true. Annuities are transfer risk products. They're commodity products, meaning there's no one size fits all and there's no perfect product and no one has the best one. You have to shop for the highest contractual guarantees for your situation and own it for what it will do, not what it might do. And the contractual guarantees only. If you stick to that and understand that they're not investments and they're contracts, you're going to be fine. But once you start edging toward the line of thinking that policy might do more than it should do, or it's contractually geared to do, then that's when the problems start. So if someone's pitching you an annuity, what you do is you write down exactly what they say to the penny, to the detail, sign and date it and have that person sign and date it, and try to flush out the truth of that too good to be true sales pitch. Because with annuities, every single time, without exception, if it sounds too good to be true, it is, because they're contracts and you can't polish those things up. They are what they are. So my advice to you is to read the contract before buying. We can provide that to you at theannuityman.com. Just a side note, I did start a YouTube channel, kind of relaunched it in September of 2019, and I'm putting out a daily video, Monday through Friday, new one. I know you're saying that's crazy. I know, but I want to educate. I want people to understand. Obviously, I want you as a client. If you're a client, thanks for being a client. If you're not, I want you as a client if an annuity fits. But I want to educate you first. I want you to make your decision, an informed decision on your terms and on your time frame with all of the information I have, whether it be the podcast you're listening to right now, the YouTube videos that I produce every day. I'm also writing an article every single day. Right now it's for thestreet.com. I have a blog on my site that we're posting stuff all the time, and you can do questions and answers to me. And you can also email me at stan@theannuityman.com, and I'll answer the email. I get tons of them. I get 400 every day on average, but I answer them. I sit there and answer them, every single one of them, because I want you to make a good decision and not buy something and get stuck into something that you can't explain. So last thing too, never buy anything you can't explain to a 9-year-old. No offense to 9-year-olds. Buy simplicity, buy the simple products, and you'll be very, very happy. So with that, hope you go to theannuityman.com and interact with us there. Maybe schedule a call and we can talk one-on-one. And my name is Stan the Annuity Man, and I really appreciate you joining me on Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.